Tell us a little bit more about the outlook for 2020 when you look at your crystal ball now. Given the strong gains that we saw across the board for equities in 2019, can we mirror the same type of returns for next year?
I think it'd be difficult to do what we did this year. Obviously, well over 20% gains so far. We are looking for a positive outlook next year. If you look at the global equity index, the MSCI All Country World, of course, we challenged the 2018 high, the January 2018 high. So, we're pulling back from that. But ultimately, as we go through next year, we do expect that to break, and that could lead to sort of maybe 5-10% gains in the first half of the year. I think thereafter, what we're a little bit worried about is the increased potential for US policy uncertainty domestically as we head towards the election. So good start to the year, and then obviously we'll see where we are from an election standpoint.
Right. Steve, we're just getting the pre-markets up and running here in Hong Kong. We're down 130 points. Retail sales, obviously, we're quite bad. I think that's an understatement here. Is it time to get Hong Kong exposure at this point?
I suppose there's two factors. Obviously, you've got the domestic situation in terms of the economic data looking pretty poor. But also, I think what will actually dominate from a price action perspective is our sense that global equities will weaken in the short term over the next 3 to 4 weeks, and that's probably going to drag Hong Kong stocks lower as well as mainland China stocks. So I think the near-term picture is pretty negative out there for on the short term. Longer term, if we say where in Greater China we prefer China offshore equities, and the main reason for that is we do expect a trade deal to be done, and therefore some of the things that have been badly hit since the trade war has escalated may well reverse out. So that's why we're shifting to a focus for China offshore shares in 2020.
Yeah, Stephen, how are you changing your sector allocation at this point?
So from a China perspective, actually still very focused on the consumer side. So consumer discretionary and consumer staples are our preferred. They've clearly had a very, very good year so far this year. But our sense is that from a fiscal policy perspective, anything that we see in any fiscal stimulus we see in 2020 is more likely to be targeted at the consumer sector as the Chinese authorities try and stabilize the economy, or at least not let it weaken too fast. So from that perspective, the consumer market still looks pretty attractive to us.
And in the fixed income space, there's been a significant amount of issuance in terms of high yield debt, dollar-denominated debt in the Asian space, about $100 billion according to some of the number crunching done by our team here. Is that issuance going to prove a drag, or is there still an opportunity in that space?
Well, actually, Asian corporate bonds are a key area of focus for us, so it's an area that we like. Obviously, around 60% of that benchmark is Hong Kong and China related entities. But within that, actually, because we've seen a massive widening in spreads, high yield versus investment grades, we actually have a preference for that space you're highlighting in terms of Asian high yield bonds over investment grade bonds, because we just think it's cheapened so much, probably due to these supply issues. And as we look into 2020, we see demand for yield being a major driver of flows into the high yield space.